Hello and welcome to Money Control. My name is Ashwin Mohan and you're watching a pre-budget special of Deal Central, where we get you the biggest voices that matter from the world of mergers and acquisitions, private equity and equity capital market transactions. Joining us on the show today is a very special guest. He's a seasoned deal maker and he's also the man responsible for transforming top investment bank JM Financial into a diversified financial services group. Joining us on the show today is Vishal Kampani. Vishal, thanks so much for taking out time and speaking to Money Control.
Thank you, Ashwin. Thank you for giving us the opportunity.
Right. Vishal, let's dive straight in. Right. If you look at the recent poll results, it was a weaker than expected mandate for the ruling party, the BJP. And therefore, I'm tempted to ask you, is there any sort of nervousness in the investor community with regards to a populist budget in as far as this time around is concerned? Also because a lot of people are looking for cues from the government, right? Because after the poll mandate, the budget, this is the full budget, right? We had an interim budget earlier this year. This is going to be the first time that they will probably have an indication and see as to what extent there is policy continuity in NDA 3.0. That's what everybody is looking forward to. So your take on that?
It's a great question. So my take is that BJP has always been standing tall for responsible growth. And a big part of responsible growth is being fiscally prudent. And I do not think that they will move away from this kind of feature that they've shown across the last 10 years of being in power. And look at the data points from FDI and FI flows, especially FPI flows. $1 billion April 1st to date, but $6 billion in the last 5 weeks, right? Which is post the election. So the momentum of capital coming into the country has been more positive and more strong post the elections. So if there was a bit of nervousness around this, large investors would wait and watch. They haven't done that. At the same time, there is no doubt that we need more rural spending. We need more capital expenditure. And if these are thoughtfully planned, and if it puts a little bit of pressure on the fisc, I think India, with the size of its economy today, can easily sustain it. I do not see investors being overly concerned about the same.
Right, point noted. Now, given the cushion that has come in, of course, from the RBI's more than generous dividend, right, 2.11 lakh crore rupees, that's a record amount. There's also a lot of tax buoyancy in the system. In April, you saw GST topping 2 lakh crores for the first time. So a lot of optimism on these two counts. But if you look at these two twin metrics, do you think that will perhaps give the government the much needed window to sort of go all guns blazing when it comes to higher capex spending? If you look at the interim budget, just for some context, they had raised the capex target to 11.11 lakh crore rupees. From the industry side also, there's been a push. You've had the CII president and the ITC head honcho Sanjeev Puri saying that there should be a 25% hike. Which side of the fence are you on, Vishal?
So again, I think fiscal prudence is important. At the same time, as I said earlier, that government capex is very, very critical. If you look at the number of approximately 11 lakh crores versus 9 lakh crores last year, just the difference in these two numbers, the capex is more than the absolute money in capex spent 10 years ago by the government. So these numbers are huge. I would be more on the side of Sanjeev Puri and say higher the capex, better.
Right. Now let's shift our focus to a monster that rears its head before every budget, right? And this is the capital gains tax regime. The same worries seem to have resurfaced, at least in some quarters. Do you think budget 2024, we could perhaps see any tinkering or changes to the existing capital gains tax regime? As it stands, Vishal, of course, we're all aware that, it's a smorgasbord of different rates, different holding periods based on different asset classes. So do you expect sort of any streamlining this time around?
Yeah, so it's actually anybody's guess, to be honest. But I think the latter part of your question is very interesting. I think streamlining it, making it very simple, making it fair across various investor classes will be appreciated. But long term, not tinkering too much with taxation is always very beneficial when a country needs capital for growth. And I think the government understands that very well. So I think they will be very responsible and they will be very thoughtful when they make any changes in the tax.
You made a fair point regarding tax policy because we are all aware of the unintended consequences, especially after the controversial retrospective tax amendment. That sort of dampened investor sentiment for a while.
Absolutely.
Till, of course, the government took care of it.
Absolutely.
So you make a fair point on the tax bit. A very unconventional view came in recently from Chris Wood, right? And I want to mention this because we're on the topic of capital gains. So Chris Wood of Jefferies said that India does not need a capital gains tax regime, and he cited the example of jurisdictions like Hong Kong, saying that those jurisdictions have benefited. How would you respond to that point of view?
No, I don't agree with that. See, I think we cannot call India a completely developed market. We have a lot of sections in our own society. We have rural, which can face difficulties simply because the monsoons can be bad. So the government has to have a very balancing act, and the government always should have reserves. And a large part of those reserves are earned when there are parts of the economy doing well who are paying tax. And capital gains tax is a big part of that. So I don't think doing away with capital gains tax is something necessarily I would agree with.
All right. Now let's shift focus to FDI, right? Now, and this is where I'm going to sort of place some emphasis on the RBI's annual report, 2023-2024. According to that, FDI, and this is net FDI flows, they fell to $10.6 billion from $28 billion a year ago. And that's, of course, on account of a rise in repatriation of FDI from India. Many believe that this has happened because a lot of the PEs are selling. And they are saying, rather than focusing on the PEs, perhaps the government should focus on FIIs instead. There should be more done to lure them. Now, keeping that as the background, do you expect any liberalization measures from the government, from the FM in this time's budget? Any tinkering of the FDI caps for certain sectors?
Yeah, so let me tell you, that is a great question. I'll take a bit of time to answer that. Right?
Go ahead.
So you've addressed or tried to address a question here with two large pools of capital. And I would say both these pools of capital are extremely important for India's perspective. The first is the private equity pool of capital. The private equity pool of capital has a horizon, right, which is 5 to 7 years in nature. And then you have the second pool of capital, both foreign sources, is the FDI, which is strategic in nature. And the third, is the FPI, which is the mutual funds, the global insurance companies, right, who are putting in secondary market capital into India. So both these, the private equity FDI and the FPI pools of capital are very important. And both are nurturing India's growth. So what happened is you saw that there was a big boom in private equity venture capital investing post-COVID. For 2 years post-COVID, there was a big boom. But you saw valuations skyrocket in the private side. And a lot of money came in. But that money systematically also needs an exit. The total pool of private equity that's invested in India today compared to some of the larger markets in the world is still very small. If you look at the top 10 private equity funds in the world and the amount of capital they have deployed in Western countries, right, India is still a pretty small percentage, but it's growing very fast. And therefore, exits become extremely critical. For them to be able to exit, show the exits to their LPs, right, allows them to bring in more money for growth. Now, coming back again to the cycle, post the cycle of valuations on the private side, you're seeing a cycle of valuations being higher on the public market side today. And therefore, companies in India are preferring to raise capital from the public market side.
Sure.
So the primary issuance activity has gone up. Right? When we look at our own deal pipeline or our ECM pipeline, it's at an all-time high today. The number of mandates we have, the number of transactions we've just done, it's at an all-time high. So, but this capital also, when raised in primary form by corporates, is going in for capex. If not capex, it's going in for debt reduction, which will improve earnings and cash flows in companies, again, which will be invested back into capex. That's the ripple effect, yes. So I think both these sort of sources of capital, whether it's FDI and PE in one bucket and FPI in the other bucket, both are very critical and both are a bit cyclical. And I feel that as a banker, and I work with all of the large global private equity clients in the country, and I don't think they've ever been happier in terms of the amount of exit momentum that they've seen in India from India's capital market. If I just take you back in history 10 years to 15 years, a large part of these exits were strategic in nature.
You wouldn't have had a Coforge block deal.
No chance.
Yeah.
Exactly. So today the Indian capital markets are actually, giving large private equity abroad an exit. This will bring 3 times the money into India in the next 5 to 7 years from the same pools of capital. So it's a big positive. I would not see the year 2023-24 in isolation. I think returning money back, and where has large part of this money come from? It's come from domestic mutual funds, family offices, and domestic retail India.
True.
So it's not private equity buying private equity. Many of these large block trades that you're seeing, one large block trade we did last year, the biggest investor in the block was a domestic mutual fund. So, and we're seeing that continuously. So I think this whole emergence of domestic capital, right? Savings being channelized through mutual funds and insurance companies has become a big dominant force. And this is great for the country's capital market.
Sure. We touched upon the block deal frenzy, right? I spoke about the Coforge block deal. You had the Blackstone Embassy block deal. I mean, there were many. You had the ITC block deal. So that's been a trend wherein you have seen large chunks of stakes being sold by private equity guys, which you said wasn't really possible a few years back. Now let's speak about the IPO market in India. That's also seeing a lot of buoyancy, right? If you look at data from FactSet, last year India hit a 9-year IPO high, 238 listings, $7.38 billion, right? So music to the ears of bankers like you. What is your take on some of the key IPO trends this year? I've noticed that the issue sizes have gone up considerably. And not only that, there are a lot of MNCs also that are looking at India. We had a record $3 billion filing by Hyundai. Who would have thought that was possible some time back? So your take on some of the key IPO trends, Vishal?
Yeah, so as I said earlier, we have our biggest IPO pipeline that we've had in the history of the firm. And I think you will see many record-breaking years in terms of India being part of the global IPO story over the next 5 to 7 years. So, and this will continue. There is a big momentum. Again, same private equity who've invested over $300 to $400 billion in the last 6-7 years in so many companies, right? Even if that money is growing at mid-teens, right? That's $700 to $750 billion of exit. Okay. So even if 20% of that were to happen through capital markets, it's a $150 billion pipeline. So $7 billion is nothing. Wow. That's $150 billion of issuance that we're going to see in the next 7 years. So there'll be IPOs, there'll be blocks, there'll be secondary offerings, and this is just 20% of the pie, right? So India's capital market is going to evolve in many ways. It will be one of the most exciting capital markets to be in for the rest of this decade. And I mean, if you ask me, after the US, it is the most exciting market in the world.
Do you expect more MNC IPOs coming in?
I think so. See, MNC companies' valuations in India are way higher than their global counterparts, or where they're listed, and even the comps. So I cannot imagine that there is any board anywhere in the globe who's looking at these valuations and is not going to push the management in India to think about India listing.
Quick take on some of the sectors where you see maximum IPO activity, and then we'll move into M&A. Any sectors where you see maximum IPO activity?
Another great question. So, I was just reviewing our entire, quarter two business just a few weeks ago, and I was seeing the breadth that we are seeing in terms of issuance, right? It's phenomenal. I mean, we are seeing it in industrials, infrastructure, hotels, real estate, pharma, healthcare. I mean, the breadth is very, very strong. So maybe barring consumer or one or two sectors that don't need that much capital, but there again, where private equities invested, they're secondary sellers.
That's true.
So we've never seen this kind of breadth. I mean, it's a great question. So it also kind of reduces the cyclicality of being focused on 2-3 sectors, right? I mean, look at metals and mining, right? You saw a rise in commodity prices, and we closed a $1 billion transaction for Vedanta recently, right? So it's just, and things are moving very fast because the capital is available, right? Thanks to our regulators, we have very high disclosure standards, right? You've got domestic capital, both in the form of mutual funds and family offices, with global capital competing for these, blocks and these QIPs. So I think it's a phenomenal space, and as I said, 7 billion is just the start. It's nowhere close to the, where we'll see this market in the next 5 to 7 years.
Right, so busy times for folks like you and
Yeah.
hopefully folks like me as well when it comes to covering them.
Yeah.
Let's shift focus to M&A, Vishal.
Yeah.
You operate in the financial services space. That's specifically an area in the last few months that has seen a lot of activity, right? A lot of deals. We had the Warburg Shriram Housing Finance deal. Awas Financiers, we are given to understand from our sources, there's a majority stake up for grabs. KKR is looking to exit Avendus. If it's not these, then you have minority stake sales and also several IPO candidates. Where do you expect maximum M&A action going ahead in India? Over and above, of course, financial services, which is extremely busy right now.
Yeah, so you're seeing the action in cement.
All right.
Right? So you have...
There are cement wars going on.
Yeah, you've got two large players who are consolidators, who want to increase sort of their presence, which both have very strong balance sheets. So why would they stop? Yeah. Right? In a fast-growing market economy, which is expected to be $7.5 trillion by 2030. If you pay 20% more for an asset today, it's nothing, right? You're going to make it up very easily by the time you grow out at 6.5%, 7% over 5 to 7 years. So that's the underlying trend where you consolidate. I think financial services in certain sectors needs to see more consolidation, right? Affordable housing finance will see much more consolidation. Sure. The entire MSME lending space will see more consolidation. Microfinance companies, they will see more consolidation. You won't just see consolidation in terms of these companies merging into themselves or like-minded companies. You will also see a lot of these becoming part of larger banks. See, understand one thing, banks are growing at 15, 16%. Yes, there is a temporary fight for deposits, which should resolve because right now you just have an equity market which is, booming. But banks growing at 15, 16%, there has not been any relaxation in priority sector norms, right? So imagine the same large, 10, 12 banks in the country growing at 15, 16%, and that means their asset base is doubling in 5 years. That means their priority sector lending requirements need to double in 5 years.
Go up, yeah.
Are they growing their branch infrastructure or are they growing their physical presence in terms of adding assets? They could be growing digitally to add liabilities, but may not be growing that infrastructure to add assets in priority sector. And therefore, microfinance companies, affordable housing finance companies, all of these platforms become very interesting plays, even from a banking perspective for consolidation. So financial services will see a lot of consolidation, a lot of new investment. We expect credit growth to be in the mid-teens for at least the next 5 to 7 years. So it'll be a great sector. But as I said, cement's an example, right? There's consolidation happening in a different form because there are two large houses, both very cash-rich, strong balance sheets, who want to, increase their market share. So there'll be different reasons in different sectors. Hotels, you're not seeing consolidation between large players because cash flows are very strong, but you're seeing a lot of consolidation of, unique or a standalone hotels being acquired by a larger group.
Even listings.
Yeah. Listings will increase because, see, in a space like hotels or a space like healthcare, right? Yeah. There's not been that much of capex in the last 15 years in some of these spaces, right? So many of those markets are actually underserved. And the Modi government has done a phenomenal job in terms of connectivity, right? They've connected all of India and they're doing it rapidly. Just look at the number of airports, roads, right? And India, from a tourism perspective, has everything to offer. I keep telling my kids and my family and my friends that, why do you need to go abroad for a holiday? India has everything. Right from Kashmir all the way down south to Goa to our beaches. If you want to take a pilgrimage, you want to go to a mountain holiday. We have everything. So once the country gets connected and you have more infrastructure, you're going to have more people who are going to prefer domestic tourism, and you have affordability going up from a lot of people because the economy is growing who want to take more vacations. Right. So hotels will boom. Hotels is an asset class I think you need to own for the next 10 years.
All right. On that optimistic note, let's also talk about the business houses, the big conglomerates, right? Private equity funds have sort of hogged the headlines when it comes to all the big buyout deals. Most of the big buyout deals. There have been a few conglomerates that have been busy. Adani Group is one, JSW to a certain extent. When do you see the big conglomerates also stepping in and signing these big checks to sort of compete against the global private equity funds?
it's actually a bit of an apples to orange comparison. Corporates, first of all, will be very sector sort of focused. So if you take JSW and Adani, they're more infra. JSW, of course, is steel. So the consolidation will really play out in some of those sectors. While the kind of private equity capital looking at India today is pretty wide, right? It's from, the road sector or, the hotel sector in terms of infrastructure, or to consumer, to pharma, to financial services. So, and I would think that the large private equity players in India are just like any other large corporate group. So you will see on a continuous basis more deal activity from private equity. You will see by sector activity from the corporates, but do I feel that corporates will surpass private equity generally in terms of acquisitions over the mid-term in India? No, my answer is private equity will buy more companies and they will pay up. They will be a little bit more aggressive when it comes to buying quality, and they also underwrite to sell, right? So in those 5 to 7 years, they're able to make the case that a sector is doing really well, we're getting it at the right time, and we'll find our exit window. And even more positive now because they've seen a lot of exits, as we spoke about earlier. Sure. Well, a corporate will take a 10 to 15-year horizon to really buy a business. So sometimes both those lenses cannot even compete on valuation.
No, fair enough. Yeah. So Vishal, we have spoken about the budget, your key expectations, we've spoken about the markets, IPOs, we've spoken about the block deal boom, private equity, conglomerates. One more question before we wrap up this interview. Yeah. Recently, there's been regulatory action against JM Financial from twin regulators, that's the RBI and the market regulator, SEBI. Has there been any progress in terms of resolving these issues, any remedial measures that have been recommended by these twin regulators? Could you give us a quick update on that?
Yes, absolutely. So we've been working very well with the regulators. We've provided them a lot of data and I'm expecting an early resolution.
Right. On that optimistic note, Vishal, let me thank you once again for taking out time and speaking to Money Control on Deal Central. It was a pleasure hearing your thoughts, and all the best in the quarters to come.
Thank you.
With that, it's a wrap on this edition of Deal Central on Money Control. Thanks so much for tuning in. This is Ashwin Mohan signing off. Stay tuned for more news, views, and updates.